Howdy, everybody. Welcome to Liberty Call. Today is Friday, January 5th, 2024. Hope everybody's having a good day out there. It is quite a nice day here in Colorado. We were supposed to get a little snow yesterday. It was about this much, basically just dusted everything. So, not that I'm upset. It means I don't have to go out and clean it up or anything like that. So, hope you're having a good day out there in the interwebs. It is the first Friday of the year, and tomorrow's the anniversary of J6. I'm sure there's a lot of people out there just wringing their hands. Oh my God, it was such a terrible thing. Anyways, all right. Well, today the markets, they did manage to finish in the green. They were, up, like over 0.5%. Then they were down in the red most of the afternoon, and it looks like they managed to squeak out some green finishes here. So, all righty. Well, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell. All right, let's go ahead and jump into the markets and see how they finished up for today. Dow Jones was up 0.07%, 25 points, closed at 37,466. S&P 500 was up 0.17%, closed at 4696. NASDAQ up 0.09, closed at 14,524. The VIX fell 5.24% today. It's back down to 1339. Canada was up 0.32, Brazil was up 0.48, and Mexico up 1.36%. Our friends over in Europe, Germany was down 0.14, the UK down 0.43, France down 0.4%, the Netherlands down 0.21, Spain down 0.18, Italy up 0.12, Switzerland down 0.34, and Portugal up 0.73%. Russian exchanges both green today. The MOEX flat up 0.01, and the RTSI up 0.48%. And the overnights, the Nikkei in Japan was up 0.4%, Australia down 0.07, New Zealand down 0.58. In China, the Shanghai was down 0.85%, the Shenzhen component down 1.07%, China 50 down 0.29%, DJ Shanghai down 0.89, Hang Seng down 0.7, and the Taiwan weighted was down 0.17%. So, like I said, markets are just kind of right now. We'll see what happens long term. All right, let's go ahead and jump over to the weekly numbers and see how they did. Let's start out with the Dow Jones. All right, here we are. Looks like it's going to finish the week down about 0.4%. The S&P 500, this short week is going to finish up down about 1.03. The NASDAQ finishes up down 2.4%. Dow Utilities up 2.16, and the Dow Transport's going to be down 2.3. So kind of a mixed week. Looks like the major indexes flattish to down, and then the minor indexes kind of split. The utilities way up, and the transport's way down. So. All righty. Well, that is how the week has finished off for the markets. And let me get my screen back up here. Let's take a peek at the economic data that came out this week. Starting out with jobless claims, came in at 202,000. Forecast was 216. Last week's number was 220,000. Continuing claims came in at 1.855 million. Forecast was 1.83. And last week's number was 1.886. So it looks like it dropped by about 20,000 there. The job openings and labor turnover survey report came in with 8.79 million jobs open. Forecast was 8.85 million, so a bit under forecast. Last month's number was 8.852. The ISM Manufacturing Purchasing Managers Index came in at 47.4. The forecast was 47.1. Last month's number was a 46.7, so a bit of an improvement there. Anytime it's below 50, that's a sign of contraction. So it's kind of a mixed signal. It is below 50, but it is improving from the last month. The ADP Non-Farm Employment Change Report came in at 164,000. Forecast was only 115. Last month's number was 101. And the Non-Farm Payrolls Report came in at 216,000. Forecast was 170. The previous month was 173. The unemployment rate held steady at 3.7%, just like last month. We were forecasting 3.8% for this month, so a bit of good news there. And the labor participation rate fell down to 62.5% from 62.8 last month, and that was what the forecast was for this month. So, All right, so that is all the data. It was a kind of a light week on stuff. We did cover the Fed minutes yesterday. So if you again, like I said in my broadcast yesterday, if you have trouble sleeping tonight or any night in the upcoming weeks, go back to that. It's the last half of the video. That's where I ramble on for about 10 plus minutes, recapping the Fed meeting from last month in December. So, all right, let's go ahead and get to the market recap. Wall Street fights to hold gains amid topsy-turvy trade, contrasting rate bet data. U.S. stock indexes faced a volatile Friday, attempting to sustain gains following conflicting signals on the timeline for interest rate cuts. Initial optimism arose from weaker than expected services sector data, hinting at a struggling economy and raising expectations for accelerated rate cuts. However, the positive sentiment was changed by robust jobs data released earlier, which contradicted the anticipation of swift easing and initially dampened futures. The ISM Institute for Supply Management, the ISM, reported a decline in services sector activity to 50.6 in December, down from 52.7 the previous month, causing uncertainty about the economic outlook. This data followed a Labor Department report indicating stronger than expected job additions in December, initially tempering the appetite for rapid rate cuts. Investors navigating a cautious start to 2024 sought clarity on the Federal Reserve's stance on interest rates. Hopes for aggressive rate cuts had driven a year-end rally in 2023, prompting profit-taking when expectations were challenged. Despite concerns, the financials index, particularly banks, performed well, with the the S&P Banks Index reaching an 11-month high. KeyCorp, Citizens Financial, and Comerica Bank saw notable gains. The broader market, represented by the S&P 500, was set for its worst weekly performance since late October. The Nasdaq also faced a challenging week, impacted by a rotation of out-of-tech stocks into defensive sectors. Applied Therapeutics experienced a significant drop of 37.6% after disappointing results from a late-stage trial of its heart disease drug. Meanwhile, Peloton saw an 8.4% jump after announcing an exclusive partnership with TikTok to bring its workout content to the short-form video platform. Investors remained vigilant, interpreting economic data and adjusting expectations as they awaited further signals from the Fed and navigated market dynamics in the early days of this new year. So, people traders or the big banks or whoever really makes all these big decisions out there were kind of disappointed that the jobs numbers did not support dropping those rates, which, again, I know I've said this over and over again. These are normal rates right now. What are we going to drop them back to? 0? We know what that creates. Inflation. We don't want that. Anyways. All right. Next up, U.S. economy adds 216,000 jobs in December. The U.S. economy added a robust 216,000 jobs in December, surpassing economists' expectations of 170,000, as reported by the Bureau of Labor Statistics. The figure marked an improvement from the downwardly revised 173,000 jobs added in November. Key sectors contributing to the employment growth included government, because we need more government jobs. They don't actually add to the economy. They're actually a drain. Healthcare, social assistance, and construction. However, the transportation and warehousing sectors experienced job losses. Despite the positive headline figures, some analysts noted underlying nuances. Kathy Jones, chief fixed income strategist at Charles Schwab, commented that while it was another solid jobs report, beneath the surface, it may not be as strong as the headline suggests. Additionally, revisions to October and November data meant that the total jobs added to those months were 71,000 lower than previously reported. The unemployment rate remained steady at 3.7%, matching the prior month's rate and slightly below the forecast at 3.8%. Average hourly earnings grew by 0.4% month on month, slightly exceeding projections of 0.3%. The release of the jobs report is closely watched by the Federal Reserve officials as they assess the potential for interest rate cuts in the coming months. The strength of the labor market is a key factor influencing the Fed's approach to managing inflation. The report follows signals of resilience in the job market, and the central bank is navigating the delicate balance of maintaining economic stability while curbing inflationary pressures. They've done such a good job so far. I have to give them a little golf clap. The data comes amid speculation about the Fed's stance on interest rates in 2024. While there were hopes for early rate cuts, recent signals from the Fed have indicated a more cautious approach, with policymakers suggesting that borrowing costs could remain elevated for some time, and that's in quotes. The employment report contributes to the broader economic narrative, shaping expectations for the Fed's future policy decisions and its efforts to engineer a, quote, soft landing to control inflation without causing economic disruptions. Okay, if you say so. I think the Fed's going to, I mean, personally, I know everyone's talking about, well, we're back to normal. We're just going to ease rates back down. Here's what I think is probably going to happen. Something unfortunate is going to happen in the economy or the markets, and it's going to cause turmoil. The stock market's going to drop like a stone like it did in 2008 and 9. And then the Fed's going to come right into the rescue like the Lone Ranger with a big sack of money like they did 3 summers ago. Or, well, I guess, 3 summers ago. And they're going to slash rates to zero. They're going to print a ton of money, and then they're going to stand there waiting for everyone to pat them on the back. And then a few years later, we're going to have more and more inflation. And then they're going to be like, how did this happen? It's a mystery. Because that has been their game plan, really going back to Greenspan back in the 90s. That's been their modus operandi. Every time we have a little hiccup or anything in the economy, they just pour cash on it, and that just seems to solve everything. So, anyways, in more economic news, this comes from Zero Hedge. It's titled "U.S. Bankruptcies Jump 18% in 23 Amid High Interest Rates," written by Naveen Atharapuli of the Epic Times. Sorry, Naveen, if I butchered your name. All right. In 2023, U.S. bankruptcy surged 18%, totaling 445,186,000 filings compared to 378,390 in 2022, revealing the economic challenges faced by businesses and households. The data from Epic AACER, a U.S. bankruptcy filing data provider, indicated a significant increase in commercial filings, rising 19% to 25,627. Commercial Chapter 11 filings, a mechanism for companies to restructure debt while retaining assets, soared by 72% from 3,819 to 6,569. The personal bankruptcy landscape also experienced an 18% increase, reaching 419,559 filings in 2023. Chapter 13 filings utilized by individuals to restructure debts rose by 18%. And Chapter 7 filings allowing filers to be exempt from certain debts while surrendering some assets increased by 17%. Factors contributing to the rise in bankruptcies include the end of pandemic stimulus, increased cost of funds, higher interest rates, rising delinquency rates. Well, I think the rising delinquency rates are due to a lack of money factors, and near historic levels of household debt. Businesses and households face challenges amid the U.S. Federal Reserve's rapid rate hikes, leading to a notable increase in loan interest rates over the past 2 years. Corporate bankruptcies also exhibited a concerning trend, with 591 filings reporting in 2023 until November, marking the highest for this period since 2020 and the second highest since 2010. The consumer discretionary sector witnessed the highest number of bankruptcy filings, followed by industrials, healthcare, financials, and consumer staples. The challenging economic environment, coupled with elevated interest rates, has led to the financial struggles for businesses, especially in sectors like retail. The impact is reflected in increased borrowing costs, making it challenging for corporations to manage balance sheets, refinance debt, and maintain profitability. Well, maybe you shouldn't have gotten so fat and happy on the easy credit that we had for the better part of a decade, and bolstered your cash reserves so you wouldn't be in this situation. I mean, that's what I help people with their personally. Anyways, on the personal front, many Americans are grappling with financial difficulties, with household debt reaching a record $17.29 trillion in Q3. And despite high levels of debt, the personal savings rate has declined to 4.1%, lower than pre-pandemic rate of 6.4 in December of 2019, indicating financial strain on individuals and their households. All right, so that's some great news going into the weekend. That delinquencies and bankruptcies are way up. So we'll see if that trend continues going into this year, and I imagine it will. But because that's usually a pretty good gauge of the economy is what bankruptcies are, delinquency rates on things like mortgages, autos, credit cards, maybe not so much. Because people they don't care about paying their credit cards, but they do care about their houses and their cars. So when those start to climb, there's some problems in the economy. So we'll see where things go long term. But that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there, and I hope you have a wonderful weekend. Got some chores planned, so woohoo! And and there's probably some football. Yeah, I guess this is the last weekend of the NFL before the playoffs start. Texans, I think if they win, they're in. I haven't looked through all the scenarios, but they should have beat the Jets a few weeks ago, and this would be a moot point. They'd be in first place. But that's how my teams are. They like to cause me grief. So, anyways, hope you have a great weekend, and I shall talk to you guys next time. Adios.